Right now, thousands of normal people are quietly making money in the stock market while you scroll past headlines feeling confused. Stay with me, because in the next few minutes, I'll break down how money is actually made in the stock market, even as a complete beginner. By the end of this video, you're going to understand exactly what the stock market is, how ordinary people like you and me make real money from it, what stock exchanges like NYSE and Nasdaq actually do, and how to own part of a company. What exactly is the stock market? The stock market is a marketplace. Just like a physical market where people buy and sell goods, fruits, clothes, electronics, the stock market is where people buy and sell ownership in companies. Instead of buying bags of rice or shoes, you're buying shares, tiny pieces of a company. Imagine a big company as a large pizza. That pizza is cut into thousands or even millions of slices. Each slice is a share. When you buy one slice, you own that small part of the pizza, and that pizza is the company. The stock market is simply the place where those slices are bought and sold. Now, here's where it gets interesting. When I say the stock market, I'm not talking about one physical building. It's actually a collection of markets and exchanges where these transactions happen. It's everywhere, it's digital, and it connects millions of people making trades every single day. This is one of the most important things beginners miss, and I need you to really understand this. When you buy a stock, you are becoming a part owner of that business. Let me say that again, when you buy a share of a company, you're not just buying a random piece of paper or a number on a screen. You are literally becoming a part owner of that business. If you buy shares of a company like Apple, Microsoft, McDonald's, or any public company, you legally own a portion of that company, no matter how small. That means you benefit when the company grows, you share in its success, and in some cases, you get paid a portion of profits, called dividends. If you own shares of McDonald's, you own a tiny piece of every Big Mac sold. If you own Apple stock, you own a fraction of every iPhone, every MacBook, every AirPod that gets sold worldwide. That's powerful. Now, obviously, if you own just one or two shares, you're not going to be making major business decisions at the company headquarters. But here's what I love about this: even as a small investor, you benefit from the company's success. When Apple makes billions in profit, and their stock price goes up, your investment goes up. When Netflix creates hit shows and more people subscribe, and their stock rises, you make money. Think about it like this: instead of just being a customer buying products from these companies, you become an owner who profits when the company does well. That's the mindset shift I want you to have. You're no longer on the sidelines. You're in the game. Now you might be wondering, why would a company even want to sell pieces of itself to random people? Why not just keep 100% ownership? Simple answer: to raise money. When companies want to expand, maybe build new factories, create new products, hire more staff, enter new countries, or invest in research, they need capital. That means money. Instead of borrowing money from banks and paying interest, many companies choose to divide ownership into shares, sell those shares to the public, and use that money to grow the business. This process is called going public, and it often starts with what's known as an IPO, an initial public offering. This is when a private company starts selling shares on the stock market for the first time. When Facebook went public back in 2012, they raised over $16 billion. That's money they could use to grow the company without taking on debt. And in return, people who bought those shares became part owners. Once that happens, anyone, you, me, everyday people, can buy shares and become part owners. Now here's the trade-off: when you're a private company, the ownership is limited to the founders and maybe some early investors. But when you go public, you're opening up ownership to everyone. You're also giving up some control, and you have to be more transparent. You've got to share your financial information with the public every quarter. But for many companies, especially ones that want to grow fast and dominate their industry, going public is the best move. And for us as investors? It's an opportunity to get in on that growth. Alright, now let's get to what you really want to know: how do people actually make money from stocks? There are two main ways, and I want you to remember both of these because they're important. First way, price appreciation. This simply means buying low and selling high. Let me give you an example. Let's say I buy a share at $50. Over time, the company grows, makes more profit, and becomes more valuable. That share is now worth $75. If I sell it, I've made $25 profit. That's price appreciation. Now, here's something important: you only make or lose money when you actually sell. If your stock goes up but you don't sell, that's what we call an unrealized gain. It's only on paper. Same thing if it goes down, you haven't actually lost money until you sell. This is crucial to understand because the stock market goes up and down constantly, and that's normal. The second way people make money is through dividends. Some companies share part of their profits with shareholders. So just for owning the stock, the company pays you, usually quarterly or yearly. Think of it like renting out a house. You still own the house, but it also pays you rent. You're getting paid just for holding the stock. Not all companies pay dividends though. Younger, growth-focused companies like Tesla typically don't because they're reinvesting all their profits back into growing the business. But older, established companies like Coca-Cola or Johnson & Johnson, they've been paying dividends for decades. So to recap, you can make money when your stock price goes up and you sell for profit, or you can receive regular dividend payments just for owning shares. Sometimes, if you're lucky, you get both. If this is already making sense and you're learning something new, take a second to like this video, it really helps more beginners find it. And if you're serious about learning how to invest and build wealth, subscribe to the channel because I'm breaking down everything you need to know, step by step. Don't forget to drop your thoughts in the comment section. I read every single comment. Now let's talk about where all this buying and selling actually happens. Stocks don't just float around randomly. They trade on stock exchanges. A stock exchange is an organized platform that lists companies, matches buyers and sellers, and ensures transparency and rules. Think of exchanges like trusted shopping malls. They don't own the goods, but they provide a safe, regulated place where transactions happen. Two of the most popular ones you've probably heard of are the New York Stock Exchange, that's NYSE, and the Nasdaq. The NYSE is one of the oldest and largest exchanges in the world. It's that iconic building on Wall Street with people in suits. Many traditional, established companies like Coca-Cola, Walmart, and Disney trade here. It's been around since 1792. Then you've got the Nasdaq, which is fully electronic, no trading floor, no shouting. It's all done through computers and networks. This exchange is known for technology and growth companies. Many big tech names like Apple, Google, Amazon, and Facebook trade here. Here's the thing though, as an everyday investor, you don't have to go to New York or physically be on these exchanges to buy stocks. Everything today is done digitally through what we call brokers. With just your phone or computer, you can access these markets from anywhere in the world. Pretty cool, right? Now you might be wondering, what makes stock prices move up and down? Stock prices move because of supply and demand. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price goes down. But what makes people buy or sell? Company profits, news and announcements, economic conditions, interest rates, and future expectations. Here's something crucial, the stock market is forward-looking. Prices move not just on what is happening now, but on what investors believe will happen next. That's why sometimes a company announces great profits, but the stock goes down because investors expected even better results. Or a company might not be profitable yet, but the stock goes up because investors believe it will dominate in the future. This is why understanding the business behind the stock is so important. You're not just buying a ticker symbol. You're buying a piece of a real company with real products, real customers, and real potential. Let's address the big question, is the stock market risky? Yes, but not in the way many people think. The real risk comes from not understanding what you're buying, chasing hype, and investing money you need urgently. Long-term, historically, the stock market has rewarded patience and discipline. Let me give you a real example. If you had invested $1,000 in Apple stock back in 2010, when they had just released the iPad and the iPhone was taking off, and you held on to that investment until today without doing anything, that $1,000 would now be worth over $10,000. That's a 10x return. Now, I'm not saying every stock will do that. Apple is obviously a special case. But this illustrates the point, when you own shares in strong, innovative companies, and you give them time to grow, your wealth grows with them. It's not about getting rich overnight. It's about owning quality businesses and giving them time to grow. That's how the stock market builds wealth. Not through luck or gambling, but through ownership and time. So let's quickly recap everything we've covered. The stock market is a marketplace for buying and selling ownership in companies. Buying shares means you own part of a business, not just a piece of paper. Companies sell shares to raise money and grow without taking on debt. People make money through price appreciation, buying low and selling high, and through dividends, getting paid just for owning shares. Stock exchanges like NYSE and Nasdaq provide safe, organized platforms where all this trading happens. And yes, there's risk, but long-term investing in quality companies has historically rewarded patience. Once you understand this foundation, the stock market stops being scary and starts making sense. In my next video, I'm breaking down all the key terms you need to know: a market cap, bull markets, bear markets, IPOs, all in simple language so you're never confused. If you found this valuable, smash that like button, subscribe for more beginner-friendly investing content, and I'll see you in the next one. Let's keep building that knowledge together.